Introduction to Underwriting. When you hear the term underwriting, think of it as the decision-making process that determines whether an insurance company is willing to take on the risk of insuring someone, and if so, under what terms. At its core, underwriting is about evaluating the level of risk an applicant presents and ensuring that the insurance company is making sound financial decisions while still offering coverage to those who need it. Imagine you're applying for a life insurance policy. The insurance company wants to know how much of a risk you are to insure. Are you healthy? Or do you have a history of medical issues? Do you have a dangerous job, like being a firefighter? Or do you work safely from a desk? Do you smoke, or are you a marathon runner? The answers to these questions help the insurance company determine if they should issue you a policy, and, if they do, how much they should charge in premiums. This is where an underwriter comes in. Underwriters are the decision-makers who analyze applications, medical records, and lifestyle factors to classify applicants into different risk categories. Their job is critical because insurance companies must balance the need to accept new policyholders with the risk of paying out claims too frequently. If they take on too many high-risk applicants without proper pricing, they could lose money and be unable to meet their financial obligations. So why is underwriting so important? Without it, the entire insurance system would be chaotic. Imagine if a company issued the same policy at the same price to a perfectly healthy 30-year-old and a 60-year-old with multiple health conditions. The company would end up paying far more in claims than it collected in premiums, eventually going bankrupt. Underwriting ensures fairness, stability, and long-term sustainability for the insurance industry. It helps keep costs reasonable for most people while still allowing coverage for higher-risk individuals, just at appropriately adjusted rates. The preliminary stage. Before the application is submitted. Before an official insurance application is even created, a lot of groundwork is done to ensure that the right people are applying for the right policies. This phase is often called field underwriting, and it's primarily the responsibility of the insurance agent who is helping the applicant navigate the process. Think of an insurance agent as the first line of defense in underwriting. Agents aren't underwriters themselves, but they are trained to recognize red flags and gather important information before an application is submitted. Their job is to help the applicant understand their options, complete the paperwork correctly, and avoid unnecessary delays or denials. One of the agent's most critical responsibilities is providing the applicant with the necessary disclosures. Insurance companies are required to be transparent about how they collect and use an applicant's information. This includes notifying applicants that their medical history might be reviewed through sources like the Medical Information Bureau, MIB, or that a background check could be conducted through credit reports. Another key requirement before an application is submitted is ensuring that insurable interest exists. This is a legal principle that prevents people from taking out insurance policies on strangers or individuals they have no legitimate financial connection to. For example, you can't take out a life insurance policy on your neighbor just because you think they have an unhealthy lifestyle and might pass away soon. However, you can take out a policy on your spouse, your business partner, or even your child, as these relationships have a clear financial or emotional connection that justifies the policy. Insurable interest must exist at the time of application, meaning that when you apply for a policy, you must have a legitimate reason to insure the person. However, once a policy is in place, it remains valid, even if that interest disappears. For example, if you take out a life insurance policy on your spouse but later get divorced, the policy doesn't automatically become void. Another important step before submitting an application is the pre-qualification process, where the agent helps assess whether the applicant is likely to be approved and at what rate. Several factors play a role here, including age, health, lifestyle, and occupation. Age is one of the biggest pricing factors in life and health insurance. Generally, the younger you are when you apply, the lower your premiums will be. Health is equally crucial. Chronic conditions like diabetes, high blood pressure, or a history of heart disease can lead to higher premiums or even denials. Lifestyle choices also matter. Smokers, for example, pay significantly higher life insurance premiums than non-smokers because smoking is linked to numerous health risks. Similarly, people who participate in high-risk hobbies like skydiving or scuba diving might face additional charges due to the increased likelihood of accidental death. Occupation is another major consideration. Some jobs are inherently riskier than others. If you work a standard office job, you're considered low risk. But if you're a construction worker, pilot, or stunt performer, insurers see you as more likely to file a claim, and you'll likely face higher premiums or additional restrictions on coverage. Once the agent has gathered all this preliminary information, they can guide the applicant toward a suitable policy and help them understand what to expect. If it looks like they might face high premiums or possible rejection, the agent might suggest alternative coverage options, such as a group policy through an employer, which often has fewer underwriting requirements. In short, this preliminary stage is all about setting expectations and making sure the applicant is matched with the right type of insurance before diving into the official application process. This helps prevent unnecessary denials and ensures a smoother underwriting process once the paperwork is submitted. The application process. Once a potential policyholder has gone through the pre-qualification process, the next step is completing the formal insurance application. This document is the foundation of the underwriting process. It provides the insurer with all the details they need to assess the applicant's risk and decide whether to approve or deny coverage, and at what price. A life or health insurance application is typically divided into three main sections. General information. This is the basic identifying information about the applicant. It includes their name, address, date of birth, social security number, occupation, and income. These details help establish who the person is, verify their identity, and determine some initial risk factors such as age and occupation. Medical information. This section asks for details about the applicant's health history, current medical conditions, past surgeries, hospitalizations, medications, and family medical history. This is one of the most critical parts of the application because an applicant's health has a direct impact on their insurability. Some applications require a full medical examination, while others rely on self-reported answers, prescription drug databases, or reports from the Medical Information Bureau, MIB, to verify accuracy. Agent's report. This section is completed by the insurance agent and contains observations that might not be included elsewhere in the application. The agent might note if the applicant appeared to be in good health at the time of application, whether they seemed honest and forthcoming with their answers, and any other relevant factors. The agent is also responsible for ensuring that all required signatures and disclosures are included. Speaking of signatures, both the applicant and the agent must sign the application. This is a legal acknowledgement that all information provided is accurate to the best of the applicant's knowledge. If false information is provided, whether intentionally or accidentally, it could result in fraud accusations, policy cancellation, or a denied claim in the future. That's why applications include fraud warnings, which remind applicants of the consequences of providing false or misleading information. Another important part of the application process is determining when coverage actually begins. This depends on whether a receipt is issued with the application. A conditional receipt is issued when the applicant submits their first premium payment along with the application. This means that if the applicant qualifies for the policy under the company's underwriting guidelines, coverage will start on the date of the application or medical exam, whichever occurs last. However, if the applicant is later found to be uninsurable, no coverage will be issued, and the premium payment will be refunded. A binding receipt, on the other hand, guarantees that coverage starts immediately, regardless of the applicant's insurability. However, binding receipts are rare in life insurance and are typically limited to auto or property insurance, where coverage is often needed immediately. Most life and health insurance policies do not provide binding coverage until the underwriting process is completed and the policy is officially approved. One more critical aspect of the application process involves privacy and medical records. Because insurers collect sensitive health information, applicants are protected under HIPAA, the Health Insurance Portability and Accountability Act. HIPAA ensures that personal medical details cannot be shared without the applicant's consent and restricts how insurers and medical providers handle private health data. During underwriting, insurers may request medical records or reports, but they must obtain written authorization from the applicant to access this information. Underwriting factors and risk classification. Once an application is submitted, it moves to the underwriting department, where a thorough evaluation begins. Underwriters use a variety of factors to determine whether to approve or deny coverage and to assign an appropriate risk classification. Some of the primary factors in underwriting include age. Generally, the younger an applicant is, the lower their risk, which translates to lower premiums. Insurance companies use mortality and morbidity tables to estimate life expectancy and the likelihood of illness. Gender. Statistically, women tend to live longer than men, which often results in lower life insurance premiums for female applicants. However, health insurance costs may vary based on gender-specific risks. Lifestyle. Applicants who smoke, drink excessively, or engage in high-risk activities like skydiving or motorcycle racing are considered higher risk and will likely face increased premiums or policy exclusions. Medical history plays a huge role in underwriting. Insurers look at both current medical conditions and past illnesses to assess long-term risk. For example, someone with high blood pressure, diabetes, or a history of heart disease may be considered higher risk than someone with a clean bill of health. Underwriters also evaluate family medical history, as hereditary conditions like cancer or heart disease can increase an applicant's likelihood of developing similar health issues. Another key factor is occupation. Some jobs come with significant risks, such as firefighting, deep-sea fishing, or working with hazardous materials. These occupations may result in higher premiums or exclusions for certain types of claims. Even less obviously dangerous jobs like long-haul trucking can be riskier than office work due to increased accident exposure. Foreign travel and residency can also impact underwriting decisions. If an applicant frequently travels to war zones or areas with high disease risks, they may face additional underwriting scrutiny. Some insurers might even exclude coverage for deaths that occur in certain countries. Underwriters use both medical and non-medical underwriting tools to gather information. If an applicant has seen a doctor for a serious condition, the insurer may request an attending physician statement, APS, which provides a detailed medical history from the applicant's healthcare provider. They also check MIB reports, which contain information from past insurance applications. If someone previously applied for life insurance and was denied due to a medical condition, the new insurer may see that record and investigate further. Other sources of underwriting data include prescription drug databases, which help verify an applicant's medication history, and credit reports, which can indicate financial stability. While it might seem unrelated, financial underwriting is important because insurers want to ensure that applicants aren't over-insuring themselves beyond what is financially justified. Based on all this information, applicants are classified into different risk categories. Preferred risk. These applicants are in excellent health, have no significant medical history, and have favorable lifestyle factors. They receive the lowest premiums. Standard risk. These applicants are in average health, with some medical history but no major red flags. They receive standard premium rates. Substandard risk. These applicants have significant health issues, high-risk occupations, or dangerous lifestyles. They may still be approved, but will face higher premiums, policy exclusions, or rating adjustments. Some applicants may receive rated policies, where they are assigned a table rating, e.g., Table A, B, C, etc. These ratings indicate that an applicant is approved, but at a higher premium rate due to their increased risk level. In some cases, an application may be declined altogether. This usually happens when an applicant has an extremely high-risk condition, such as a terminal illness, or engages in illegal activities that make them uninsurable. While it's never ideal for an applicant to be denied, they may have other options, such as guaranteed issue policies, which don't require medical underwriting but come with higher premiums and lower coverage amounts. At the end of the underwriting process, the insurer makes a final decision on whether to approve or deny the policy, and at what rate. The next step is issuing and delivering the policy, which we'll cover in the next section. Medical examinations and testing medical exams play a crucial role in underwriting because they provide insurers with objective, verifiable data about an applicant's health. While an application might contain self-reported health information, medical exams ensure accuracy by confirming details that could affect insurability and premium rates. The type of medical exam required depends on the applicant's age, coverage amount, and medical history. For some policies, particularly simplified issue or guaranteed issue policies, no medical exam is required. However, for traditional life and health insurance policies, insurers often request either a paramedical exam or a full medical exam. A paramedical exam is a basic health assessment conducted by a medical professional, typically a nurse or paramedic. It includes measuring height, weight, blood pressure, and pulse. A full medical exam, on the other hand, is more comprehensive and is conducted by a physician. This might be required for older applicants or those seeking high coverage amounts. One of the most common tests insurers require is a blood test and urinalysis. These tests check for a variety of health indicators, including nicotine use. Smokers generally pay significantly higher premiums than non-smokers. Even occasional tobacco use, such as cigars or nicotine patches, can impact underwriting decisions. HIV and other infectious diseases. Some insurers test for HIV, hepatitis, or other conditions that could affect life expectancy. Drug use, illegal drug use, or abuse of prescription medications can lead to a denied application. Even marijuana use, depending on state laws and insurer policies, may impact eligibility. Cholesterol and blood sugar levels. These are used to assess the risk of heart disease and diabetes. For applicants over a certain age or those with a history of heart conditions, insurers may also require an electrocardiogram, EKG. This test records the heart's electrical activity and can detect irregularities that might indicate an increased risk of a heart attack or other cardiac issues. In some cases, additional diagnostic tests, like a stress test or chest X-ray, may be required. In addition to medical exams, insurers rely on external databases like the Medical Information Bureau, MIB, to verify applicants' health histories. The MIB is a nonprofit organization that maintains records of previous insurance applications, including medical conditions that were disclosed during past underwriting processes. The MIB's function is to prevent fraud and inconsistencies in applications. If an applicant previously applied for life insurance and reported having diabetes but doesn't mention it on a new application, the insurer can cross-check this information through the MIB. However, the MIB doesn't store actual medical records, just coded alerts that indicate an applicant may have had a condition worth investigating. One area of increasing concern in underwriting is genetic testing. Some applicants may have undergone genetic testing to assess their risk of developing diseases like cancer or Alzheimer's. However, under the Genetic Information Non-Discrimination Act, (GINA), insurers cannot use genetic test results to deny coverage or increase premiums in health insurance. This law was put in place to prevent discrimination based on genetic predisposition. However, GINA does not apply to life insurance, disability insurance, or long-term care insurance, meaning some insurers may still consider genetic risks in underwriting those types of policies. Underwriting for special risk groups. Not all applicants fit into the standard underwriting categories. Some individuals present unique risks based on their occupations, hobbies, age, or the type of coverage they are applying for. Special underwriting guidelines exist for these groups to ensure that insurers can properly assess and price their policies. High-risk occupations and avocations. Certain jobs and hobbies increase an applicant's likelihood of injury or premature death. These are known as high-risk occupations and avocations. Examples of high-risk jobs include firefighters, police officers, pilots, commercial fishermen, construction workers, oil rig workers. Additionally, some hobbies are considered hazardous, such as skydiving, scuba diving, rock climbing, racing motorcycles, or cars. Applicants in these categories may face higher premiums, coverage exclusions, or, in some cases, outright denial of coverage. For example, a recreational skydiver may be offered coverage, but their policy might include an aviation exclusion rider, meaning no benefits would be paid if they die while skydiving. Some insurers also require applicants to fill out a special questionnaire detailing their experience level and frequency of participation in risky activities. Underwriting for senior applicants. As applicants age, underwriting becomes more focused on age-related health risks. Older applicants are more likely to develop chronic illnesses like heart disease, cancer, or cognitive decline. For seniors, life insurance policies often come with higher premiums and stricter underwriting requirements. Many seniors opt for final expense insurance, which provides smaller coverage amounts designed to cover funeral costs. Additionally, many older applicants look into long-term care insurance or chronic illness riders. These policies help cover nursing home care, assisted living, or in-home care if the policyholder becomes unable to care for themselves. Since long-term care is expensive, insurers conduct thorough underwriting, often requiring cognitive function tests and assessments of the applicant's ability to perform daily activities like dressing, bathing, and eating. Underwriting for juvenile policies. Children can also be insured through juvenile life insurance policies, typically purchased by parents or guardians. These policies often provide low face amounts and serve as a way to guarantee future insurability. A key requirement for juvenile policies is parental signatures and proof of insurable interest. Parents must demonstrate that they have a legitimate financial interest in the child, which is usually easy to establish. However, insurers also want to ensure that children are not overinsured, meaning a child's policy coverage amount must be reasonable compared to the parent's own coverage. For example, if a parent has a $100,000 life insurance policy, an insurer is unlikely to approve a $500,000 policy on their child. The logic is that life insurance is meant to replace lost income, and children typically do not contribute financially to a household. Underwriting for group life and health insurance. Unlike individual insurance, group insurance, such as employer-sponsored plans, follows different underwriting principles. Instead of assessing each person individually, insurers evaluate the group as a whole. Some key differences between individual and group underwriting include guaranteed issue. Most group life and health insurance policies do not require medical exams or individual underwriting. As long as an employee is eligible, e.g., they work full-time, they are automatically approved. Lower cost. Because group insurance spreads risk across many individuals, premiums are typically lower than individual policies. Employer contributions. Many employers subsidize part of the cost, making coverage more affordable for employees. While group insurance is a great option for many people, it often comes with limitations. Coverage amounts for group life insurance tend to be lower than what an individual might need. If an employee leaves the company, they may lose their coverage unless they have the option to convert their group policy to an individual policy. Overall, underwriting for special risk groups requires insurers to carefully assess the applicant's unique circumstances and adjust coverage accordingly. Whether it's an individual with a high-risk hobby, a senior looking for long-term care coverage, or an employee enrolling in a group plan, underwriting ensures that policies are priced fairly based on the level of risk involved. Underwriting in health insurance. Underwriting for health insurance differs significantly from life insurance underwriting. While life insurance underwriting is primarily concerned with mortality risk, how long an applicant is expected to live, health insurance underwriting focuses on morbidity risk, meaning how likely an applicant is to require medical care and how much that care will cost. One of the biggest differences between life and health insurance underwriting is how pre-existing conditions are handled. Before the passage of the Affordable Care Act, ACA, health insurers could deny coverage or charge significantly higher premiums for individuals with pre-existing medical conditions, such as diabetes, heart disease, or cancer. However, under the ACA's protections, health insurers are prohibited from denying coverage or charging higher rates based on an individual's health status. This means that someone with a history of serious medical conditions has the same access to health insurance at the same rates as a healthy individual of the same age and location. The ACA also introduced community rating in health insurance underwriting. This means that insurers set premiums based on broader population demographics rather than an individual's health history. Community rating ensures that premiums are determined by factors like age, geographic location, tobacco use, and plan type, rather than specific medical conditions. This is different from an individual rating system, where an insurer would assess each applicant's risk individually and adjust premiums accordingly. Although traditional health insurance no longer uses detailed individual underwriting due to ACA regulations, other types of health-related insurance, such as disability income insurance and long-term care insurance, still require a more detailed underwriting process. Underwriting for disability income. Insurance, disability income insurance, provides income replacement if an individual becomes unable to work due to illness or injury. Since this type of insurance directly replaces lost income, underwriting is focused on factors that affect the applicant's ability to work. Key underwriting considerations include occupation. Some jobs come with higher risks of disability. A construction worker or firefighter is more likely to suffer a disabling injury than an office worker, which means they may face stricter underwriting requirements or higher premiums. Health history. Unlike ACA-compliant health insurance, disability insurance underwriters can still consider an applicant's medical history. A person with a history of back problems or mental health conditions may face exclusions or limited benefits. Income level. Since disability insurance is designed to replace a portion of income, insurers verify an applicant's current earnings to determine how much coverage they qualify for. Underwriting for long-term care insurance. Long-term care, LTC insurance, covers services such as nursing home care, assisted living, and home health care for individuals who are unable to perform basic daily activities due to aging or illness. Because the likelihood of needing long-term care increases with age, LTC underwriting is one of the strictest in the industry. Key underwriting factors for LTC insurance include age. The older an applicant is, the more likely they will require long-term care, leading to higher premiums and potential coverage restrictions. Many insurers decline applicants over a certain age or require significant health screening. Medical history. Pre-existing conditions like Alzheimer's disease, Parkinson's, or severe arthritis can result in automatic declines since they indicate a high likelihood of needing long-term care. Cognitive and physical health. LTC insurers often require applicants to pass cognitive function tests and physical assessments to ensure they do not already need assistance with daily living activities like dressing, bathing, or eating. Because long-term care insurance is expensive and has strict underwriting requirements, some people choose alternative options, such as hybrid life insurance policies with long-term care riders or self-funding their care. Laws, regulations, and ethical considerations. Insurance underwriting is heavily regulated to ensure fairness, protect consumer privacy, and prevent discriminatory practices. Several key laws govern how insurers can use medical and financial information in underwriting. Fair Credit Reporting Act, FCRA. The Fair Credit Reporting Act, FCRA, regulates how insurers use consumer reports, such as credit scores and financial history, in underwriting. Since financial stability is an important factor in life and disability insurance, underwriters often review an applicant's credit history to assess the risk of policy lapse, i.e., whether the applicant is likely to stop making premium payments. Under the FCRA, applicants must be notified if an insurer uses credit information to make underwriting decisions. If an application is denied or rates are increased due to a credit report, the applicant has the right to request a copy of the report and dispute any inaccuracies. Health Insurance Portability and Accountability Act, HIPAA. The Health Insurance Portability and Accountability Act, HIPAA, is primarily known for protecting medical privacy. When it comes to underwriting, HIPAA ensures that an applicant's medical records, test results, and other health data remain confidential. Insurers must obtain written authorization before accessing an applicant's medical records. Underwriters cannot share an applicant's health information with unauthorized parties. Applicants have the right to access their own medical records and request corrections if needed. HIPAA also restricts the use of certain health information in underwriting for group health plans, preventing insurers from denying coverage or charging higher rates based on pre-existing conditions. Genetic Information Non-Discrimination Act. The Genetic Information Non-Discrimination Act was passed to prevent health insurers from using genetic test results to make underwriting decisions. For example, if an applicant undergoes genetic testing and learns they have a high risk of developing Alzheimer's, a health insurer cannot use this information to increase their premiums or deny coverage. However, GINA only applies to health insurance. Life insurance, disability insurance, and long-term care insurance are not covered under GINA, meaning insurers in those markets can still consider genetic risks when making underwriting decisions. State regulations on underwriting practices. In addition to federal laws like HIPAA and GINA, each state has its own regulations governing insurance underwriting. State insurance commissioners oversee underwriting practices to ensure they are fair and non-discriminatory. One key regulation in most states is the prohibition of unfair discrimination in underwriting. While insurers are allowed to classify risks and charge different premiums based on legitimate factors like age and health, they cannot discriminate based on race, gender, disability, religion, or other protected classes. For example, race-based underwriting is illegal. An insurer cannot charge higher premiums based on an applicant's race. Gender-based pricing is restricted in some states. Some states have banned different life insurance rates for men and women, even though actuarial data shows differences in life expectancy. Disability discrimination is limited. While insurers can consider health risks, they cannot deny coverage solely based on a disability if the applicant otherwise qualifies for the policy. Consumer rights and the right to appeal. Consumers have rights when it comes to insurance underwriting decisions. If an application is denied or rated, meaning the applicant is assigned a higher risk category with increased premiums, they have the right to request a written explanation of the underwriting decision, review and dispute any incorrect medical or financial information used in underwriting, appeal the decision and provide additional medical records or clarification. Many states require insurers to have a formal appeals process, allowing applicants to challenge underwriting decisions if they believe they were made unfairly. Underwriting is a highly regulated process that balances risk assessment with consumer protections. While insurers must evaluate applicants fairly and accurately, they must also follow laws that protect privacy, prevent discrimination, and ensure transparency. These regulations help maintain trust in the insurance industry while allowing insurers to operate profitably. Policy issuance and delivery. Once underwriting is complete, the final step before an insurance policy takes effect is policy issuance and delivery. This stage ensures that all terms are set correctly. The policyholder understands their coverage, and any last requirements are met before the contract is officially enforced. The underwriter performs a final review to confirm that the applicant's risk classification is accurate and that the correct premium amount has been assigned. This is crucial because an error in classification could result in the insurer charging too little for a high-risk applicant or overcharging a low-risk applicant, both of which could lead to financial and legal issues. Once the policy is approved, it is issued and must be delivered to the policy owner. There are two main methods of policy delivery. Personal delivery. The agent meets with the policy owner to hand-deliver the policy and explain its key provisions. This is preferred because it allows the agent to answer questions, review the policy face-to-face, and ensure the applicant understands their coverage. Mail delivery. If personal delivery is not possible, insurers may mail the policy directly to the policy owner. However, this method lacks the opportunity for a direct discussion about the policy details. When delivering a policy, an agent should go over key details such as the policy type and coverage amount, the beneficiaries, and how death benefits are paid for life insurance, any riders or exclusions attached to the policy, the premium payment schedule, and consequences of non-payment. At this stage, premium collection may also take place. If the initial premium was not submitted with the application, it must be collected before the policy goes into effect. Additionally, the insurer may require the policy owner to sign a statement of good health, confirming that their health has not changed since the initial application. This protects the insurer from issuing a policy to someone whose health may have deteriorated after underwriting, but before the policy became active. The policy effective date depends on when the premium is paid. If the premium was paid at the time of application and a conditional receipt was issued, coverage may be retroactive to the date of application or the date of a required medical exam. If the premium is paid upon delivery, the policy is not effective until payment is received and any additional requirements, such as a statement of good health, are met. Another important consumer protection is the free look period, which allows policyholders a set amount of time to review their policy and cancel it for a full refund if they change their mind. The length of the free look period is mandated by state law, typically ranging from 10 to 30 days. If a policyholder cancels within this time frame, the insurer must issue a full refund of any premiums paid, and the policy is voided as if it never existed. The free look period is particularly important for complex policies, such as variable life insurance or long-term care insurance, where policy owners may need extra time to review the details and confirm that the coverage meets their needs. Underwriting, trends, and technology. Insurance underwriting has evolved significantly due to advancements in technology. Traditional underwriting relied heavily on manual review processes, requiring human underwriters to analyze medical records, financial data, and risk factors. Today, technology is transforming underwriting by making it faster, more accurate, and more data-driven. Artificial intelligence in underwriting. Artificial intelligence, AI, is being used to automate and improve underwriting decisions. AI can quickly analyze vast amounts of medical data, lifestyle information, and financial records to assess risk more efficiently than a human underwriter. Some key benefits of AI in underwriting include faster processing times. AI can review and approve applications in minutes instead of weeks. Improved risk assessment. Machine learning models can detect patterns in medical history and lifestyle choices to predict future health risks more accurately. Reduced human bias. AI applies consistent criteria to all applicants, reducing the risk of subjective decision-making. However, AI also raises ethical concerns. Since AI models rely on historical data, there is a risk of inherent bias in underwriting decisions if past discrimination is reflected in the data. Insurers must carefully monitor AI systems to ensure fairness and compliance with anti-discrimination laws. Predictive analytics and big data. Predictive analytics uses big data, large sets of information from multiple sources, to help insurers predict an applicant's risk level. Insurers can now analyze data from wearable fitness devices, e.g., smartwatches that track heart rate and activity levels, social media activity. Some insurers analyze lifestyle patterns based on public online behavior. Pharmacy and prescription databases, electronic health records, EHRs. By using predictive analytics, insurers can refine their risk models and offer more customized pricing, meaning healthier individuals may receive lower premiums based on real-time data rather than generalized age and health tables. Automated underwriting versus traditional underwriting. With the rise of technology, many insurers are shifting toward automated underwriting, which uses algorithms and data analysis to approve applications instantly, particularly for simplified issue and guaranteed issue policies. Unlike traditional underwriting, which requires detailed manual review, automated underwriting can process applications instantly or within hours, reduce the need for medical exams and lengthy questionnaires, offer more streamlined and cost-effective policies. However, traditional underwriting is still required for complex cases, such as applicants with significant medical conditions or high policy amounts. Automated underwriting works best for low-risk applicants, while human underwriters still play a key role in evaluating non-standard risks. Impact of telemedicine and electronic health records, EHRs. Telemedicine and electronic health records, EHRs, are revolutionizing the way insurers access medical information. In the past, underwriting often relied on physician statements and traditional medical exams, which could take weeks to obtain. Today, insurers can access EHRs instantly to review an applicant's health history. Telemedicine has also impacted underwriting by providing quicker virtual health assessments. Instead of requiring an in-person medical exam, some insurers allow applicants to complete video-based health evaluations with licensed professionals. This makes the process more convenient and efficient while still allowing insurers to assess health conditions accurately. The future of underwriting. The integration of AI, big data, and telemedicine is rapidly changing the underwriting landscape. While traditional underwriting will still be necessary for high-risk cases, most standard applicants will experience a faster, more automated process in the coming years. At the same time, regulatory oversight will continue to evolve to ensure that underwriting remains ethical, fair, and non-discriminatory. As technology continues to improve, underwriting will become more data-driven, personalized, and efficient, ultimately benefiting both insurers and policyholders. Mastering underwriting concepts for the licensing exam. Now that we've covered the entire underwriting process, let's talk about what you can expect on the insurance licensing exam. This section is all about helping you retain key concepts, recognize common question patterns, and confidently apply underwriting principles to real-world scenarios. The underwriting section of the exam will test your understanding of how insurers evaluate risk, what factors they consider, and how they classify applicants. You can expect to see questions about regulations, ethical considerations, and important laws such as the Fair Credit Reporting Act, FCRA, HIPAA, and the Genetic Information Non-Discrimination Act, GINA. The exam will assess your knowledge of consumer rights, privacy protections, and unfair discrimination. Questions will also focus on the application and policy delivery process, including the different parts of an application, required disclosures, and distinctions between conditional and binding receipts. Additionally, you will need to understand risk classification and how applicants are categorized as preferred, standard, substandard, or declined based on factors such as medical history, financial background, and lifestyle choices. Another key area of focus will be medical and non-medical underwriting tools, including the Medical Information Bureau, MIB, attending physician statements, APS, prescription drug databases, and credit reports. Most underwriting exam questions will fall into one of three categories: definition-based, process-based, or scenario-based. Some questions will ask you to define key terms and concepts such as adverse selection, insurable interest, table rating, or MIB. Others will focus on the underwriting process itself, requiring you to understand the steps involved in assessing an applicant's risk, the purpose of different medical exams, and the role of the agent in field underwriting. Some of the most challenging questions will present real-world scenarios where you must apply underwriting principles to determine the correct course of action. For example, you may be given details about an applicant's medical history, occupation, or hobbies, and be asked how an underwriter would classify their risk, what additional information might be needed, or whether a policy would be issued, modified, or declined. To be fully prepared, you should commit several key concepts to memory. Insurable interest is one of the most important ideas to understand, especially the fact that it must exist at the time of application for life insurance, but not necessarily at the time of death. Another critical distinction is between conditional and binding receipts. A conditional receipt provides temporary coverage only if the applicant meets underwriting requirements, whereas a binding receipt guarantees coverage for a set period regardless of underwriting approval. You should also be able to explain how insurers classify risk and determine premiums based on preferred, standard, or substandard risk categories. High-risk applicants may receive rated policies with table ratings or be declined altogether. It is also essential to know the difference between medical and non-medical underwriting, including the role of medical exams, APS reports, MIB data, and credit history in evaluating risk. Questions about laws and regulations will likely appear on the exam, and you should be able to recall the basic protections offered by FCRA, HIPAA, and GINA. When answering underwriting questions, it is helpful to think like an underwriter. If a scenario presents an applicant with multiple risk factors, consider whether additional medical testing would be required, whether a higher premium would apply, whether an exclusion or rider might be added, or whether the application would be denied. Some scenarios will describe a person's health history, occupation, or lifestyle, and ask how an underwriter would handle their application. These questions require you to analyze multiple risk factors at once and determine the best underwriting action. To succeed on the exam, it is important to understand the concepts rather than just memorizing terms. Many questions will test your ability to apply knowledge rather than simply recall definitions. If you are unsure of an answer, try eliminating choices that are clearly incorrect and focus on finding the best option. Paying attention to keywords in the question, such as always, never, or except, will help you avoid mistakes caused by misreading. Flashcards are an excellent way to reinforce key definitions, risk classifications, and laws, making it easier to recall important information quickly. Mastering these underwriting principles and practicing with real-world scenarios will help you approach the exam with confidence. With a solid understanding of how the underwriting process works and how insurers assess risk, you will be well prepared to pass your insurance exam and start your career in the industry.